Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host for today, Stephen Irwin, investment manager based out of our Belfast office. And this week, I'm pleased to be joined by Richard Carter, our head of fixed interest research, and Oli Creasey, one of our research analysts. Let's start with the UK and provide an update from the discussion last week. Since Keir's initial resignation announcement, the focus has shifted away from the leadership change itself, with Andy Burnham the clear frontrunner, and more towards the next government, at what the next government might actually look like, and in particular, the policy direction from here. Richard, market reactions have been relatively muted since the announcement. Do you think the leadership change was largely priced in, and what do you think investors are now focusing on?
Yeah, I think the leadership change, Stevie, was priced in, although I think markets were sort of relieved that they may not like Andy Burnham that much necessarily, but it looks like he's going to be prime minister within a few weeks, and there's not going to be some prolonged leadership battle over the summer with all sorts of different ideas being floated. So I think they're fairly relieved about that. I mean, they obviously want to know more about sort of policy, what fiscal rules are going to be, what's going to happen to the fiscal rules, how are they going to stick to those, or are they going to change them? How are they going to come up with interesting and dynamic policies when the cupboard's pretty bare in terms of money? But I think in some ways Burnham has been a little bit lucky with what's been going on in the Middle East. Obviously, you had the big rise in gilt yields reflecting higher inflation expectations, and now that's reversed as a sort of fragile peace deal has been worked out, and that sent gilt yields back down again. So in some ways, he's been a bit lucky with that, and now we'll just have to see what sort of policies he comes up with. But clearly, who's going to be Chancellor is the big one to find out about, but I don't think we're going to know that for a few weeks yet.
Yeah, you've beat me to it, Richard. I mean, that's the next question, and I think that's one of the most important questions. Who is going to be the choice of Chancellor? I know there's already been speculation around the potential candidates, including Ed Miliband. I think he is probably the least market friendly, particularly given his focus on the green agenda and the potential scale of investment required to deliver that. What's your take on who might fill that role, and how should investors be thinking about the implications, particularly in terms of, as you've just mentioned, the fiscal credibility and how any additional spending might ultimately be funded?
Yeah, I mean, I think at the end of the day, there's all the fiscal rules and how they might be fudged and changed, which have been many times in the past. You can't kind of fudge the gilt issuance, if you know what I mean. Even if they change the fiscal rules or something else, what the gilt market will be looking at is how is it going to digest the number of bonds that they plan to sell in any given year, and not forgetting the fact that the ownership base of the gilt market has shifted. You've got less, the Bank of England aren't really buying, pension funds aren't buying as many, and you're more reliant on overseas investors, you're more reliant on, say, maybe mutual funds buying a gilt market, and they're more flighty and more price sensitive. So they can come out with some great speeches and change fiscal rules, but you have to be able to sell those gilts, and it has to be in a sort of sensible way that the market can digest. I mean, the next Chancellor. There's been a lot of pushback, not just actually from markets about Ed Miliband, also from unions who have sort of accused him of, being, anti-jobs and all the rest of it. So it's possible he might still go for Miliband, but there are, the focus is increasingly on the other options like Streeting, like Shabana Mahmood, maybe even Yvette Cooper, who is, Foreign Secretary at the moment. She's a possible, I would say, as well. But it will really go back to sort of what their policies are and how much credibility there is. I think we shouldn't forget, I mean, the market might like a more, centre-lefty kind of Wes Streeting kind of chancellor, but you do want, I think, alignment between the Prime Minister and whoever's Chancellor of the Exchequer, because if they fall out with each other at an early stage, that's not going to be good either.
Yeah, that is interesting. And then just stepping back more broadly, we've seen a high degree of political turnover in the UK over the past decade, which inevitably raises the question around policy consistency. It does feel like we keep running into the same challenges regardless of who's in power. Do you think this is mainly about individual leadership, or is there a deeper structural issue where governments simply can't fulfill their promises given the state of the public finances?
Yeah, that's definitely not helping. I mean, I think there's a mix of reasons. I mean, if you look at the first few, went after Brexit. I mean, Cameron, Theresa May, really a sort of victim of the result of the referendum, and then trying to get a sort of Brexit deal done. You then had COVID. And the cost of living crisis because of what happened in Ukraine. And I think, Boris Johnson and arguably Liz Truss and Rishi Sunak were all victims of that. But Liz Truss, for example, was never suitable really to be Prime Minister, and actually having members of parties select who their leader is rather than just MPs is probably has probably caused a few issues. I think you can say that about Jeremy Corbyn as well in the Labour Party. Whoever party members pick may not be ideal in terms of leading a party if you're trying to govern on behalf of or be elected by the whole of the country. And then if you look at Keir Starmer, I don't think he's really completely hamstrung by the public finances. Obviously don't help, but I think he just really wasn't suitable or charismatic enough to be Prime Minister. With Andy Burnham sort of waiting in the wings, it's really done for him. But hopefully, we're not going to be having this situation for the next 5 to 10 years where the Prime Minister's changing every 2 years, because it's not helpful.
No, that's great. Now we'll see how it unfolds over the next few weeks. It's worth noting that we're recording on Monday the 29th, so I'm conscious that Andy's speaking later today, so hopefully all we've spoken about doesn't become outdated very quickly. But we'll move now on to UK property. So it is a sector that's been through a significant adjustment over the past few years as it's had to adapt to higher interest rates. Alongside that, we're seeing a changing political and economic backdrop, all of which has been challenging. But importantly, it's not without presenting some opportunities. So it feels like it's a good time to bring Oli back onto the podcast, to give us an update on how he's thinking about the space. So Oli, to begin with, how are you currently thinking about the UK property market more broadly? And do you see any key themes shaping the sector at the moment?
Yeah, hi Stephen. Good morning, and thanks for inviting me back on. It's a tricky market, the UK property market at the moment. There's a phrase that keeps getting thrown around that I actually don't like, but I will repeat it anyway, and that is that one is feeling cautiously optimistic. Right, you can probably see why I'm not a big fan of it, but unfortunately it does kind of seem to work. It sums up where we are a little bit in the property market. We're not completely down in the dumps. We're not experiencing the type of yield expansion that we saw in 2022 and 23. Things have very much normalized since then. Valuations have normalized as a result. Rents are continuing to grow. Things are sort of steadily moving on. It's not an exciting market at the moment, I'm afraid to say, but it is one that is delivering decent, if not hugely remarkable returns. You probably didn't want to hear that from a podcast special guest. I'm sure you wanted something a little bit more exciting. What I will add to that, to maybe bring a bit of excitement, is that there are a few themes out there that are generating a bit of traction. I'm afraid to say they're possibly a little bit obvious at this point. Certainly, the first one, data center investment, is very hot right now. That you can, I'm sure, understand the reasoning why. The AI boom is well underway, and the data centers are the sort of the picks and shovels of that boom. So owning, developing a data center somewhere in the world, including the UK, is proving to be quite a profitable business if you can get it right, at least, and if you can find the right tenant and all of that. But do it right, and there seems to be good money to be made in that sector. Elsewhere, you could also perhaps point to things like senior living, which is also a sector supported by a very solid supply-demand imbalance at the moment. The aging population in the UK and actually the rest of the world really is big, and it is growing, and it is not being matched by growth in senior living, whether that's just a sort of supported housing or more sort of serious elderly care homes. The number of beds there is not growing at anything like the same rate as the number of people who might need them. Now that might well represent a sort of a social issue and a problem for someone to solve, but for investors, it's actually one that is quite a positive theme that one might want to consider a little closer. I guess maybe if I could just, I'll bring the tempo down a little bit and just say that actually, while property is seeing some of these trends emerge, one of the things that is still hanging over the property world, I suppose, in a way, is that it's become very much interest rate driven, and actually the themes like the themes I've mentioned are sort of still front and center in their subsectors. There's a lot of other property out there which seems a little bit maybe even themeless at the moment, where the sort of the macroeconomic situation is dominating the news still. It's hard to kind of get as excited about your more general office, retail, residential type assets, when you're thinking mostly about where the yield curve might be heading. There's less to be said about those traditional sectors, unfortunately. But it's not a sector without its cautious optimism, should we say?
Yeah, thanks. I think it's a bit unfair for you to describe the UK property market as dull, but we'll roll with that. So, sticking with more recent developments, and this is more exciting. There was some interesting news last week around Segro, which is one of the names you've been positive on. Can you just walk us through what's happened there and what it potentially tells us about valuations in the UK property sector more broadly?
Yes, I will, and maybe I'll just start by saying, in some investment circles, dull isn't a rude word, right? There's probably some people who'd be quite happy with dull returns. So let's leave it there. Segro is a really interesting story, actually. I'll give you a little bit of the background first. So Segro is a UK-based but European operating, so sorry, UK and European operating company, a UK REIT, in fact, that owns primarily industrial and logistics properties throughout the continent. Also has a little bit of data center exposure that's growing as well. So that sort of ties into that earlier theme that we mentioned. Prologis is a US mega cap REIT, broadly invested in the same sectors, but with a sort of global outreach. They are, I think, the second biggest REIT in the US, the second biggest property company, and I think that probably puts them in contention to be one of the biggest publicly listed property companies in the world. On Wednesday last week, Prologis and Segro sort of both separately acknowledged that private discussions had been held in the weeks prior to that about a takeover, Prologis buying Segro for using Prologis shares as the sort of main currency. Segro's management board and board of directors rejected that approach from Prologis, and that announcement then sort of was made to perhaps stir up the pot a little bit and see what happens next. So where we are today is that there's a bid that has not been formally made, but has been discussed. It originally valued Segro at about 925 pence per share, but obviously given we're using Prologis shares as currency, that has moved a little bit since. There's a lot to all of this. So going back a year, 2025 was a year of market consolidation within the UK REIT market. There were quite a few takeovers, mergers, acquisitions, etc. I actually said probably about 2 weeks ago to a few people that it didn't feel like 2026 was going to go the same way. So I probably shouldn't have said that, because clearly that was me tempting fate. Segro, the UK largest publicly listed property company, now effectively up for sale in a sort of in a roundabout way. Um, it is quite a sort of seismic change. What we saw in 2025 was a lot of small companies be bid for, and consolidation take place. Those small companies get sort of rolled up into big companies. This is a big company, being taken overseas and rolled up potentially anyway into an even larger uh, uh, overseas operator. Um, it changes the game a little bit. Previously, we might have thought that a company like Segro was a bit too big, perhaps, to elicit a bid like this. There's probably a handful of other names out there that we thought were too big, and if not too big, then perhaps too complex. The existence of this discussion and potential bid is putting paid to those ideas, and very much meaning that the entire sector is perhaps a little bit more in play than we thought. But you're absolutely right to highlight valuation. I mean, the 925 pence number was not chosen entirely at random. It represents Segro's NAV. And it's important because Segro's share price prior to the Wednesday's announcement, I don't actually have the number in front of me, but it was substantially lower than that. Let's say it was in the region of 25% below that number. Shares have obviously rebounded quite strongly, or also re-rated quite strongly in the light of the news. Still not trading at 925 exactly, but sort of very much closed that gap. And this is the point here. This is why Prologis have perhaps got involved in the first place, is that Segro and the rest of the UK REIT market really is trading quite some way below what the perceived fundamental value of the underlying assets is. Now, we can argue about whether that value is true and accurate. It probably isn't accurate to the decimal place, but it's not a bad starting point for these conversations. And yet, the entire market is probably trading at an average of 25 to 30% below it. That valuation gap is material, and it is enticing to investors and would be acquirers like Prologis and others. What this news means is perhaps that the rest of the market really is in play, and if a re-rating doesn't happen organically, it could well happen inorganically, which is what we've seen in the last week here.
Yeah, it is super interesting. It'll be interesting to see if there's any more activity over the next year or two on that as well, just because of that disconnect. And then just before we finish up, I think it's worthwhile briefly touching on the house builders. They've had a fairly challenging couple of years with the higher borrowing costs and increased just costs in building. At the same time, they're clearly quite sensitive to government policy, particularly around the planning reform and housing targets. So how are you currently viewing the house building sector, and to what extent do you think changes in the political landscape could influence the outlook from here?
Yeah, another good question, some good observations there. I think, unfortunately, I'm not sure I can be even cautiously optimistic on the house builder market at the moment. I'm not sure what's lower down on the scale there, but it's a let's use a cricket analogy. They're on a fairly sticky wicket at the moment, and I can tie that into the fortunes of the English cricket team if you wish. Um, yeah, there's obviously a lot of complications to it, but in very, very simple terms, house builders are struggling at the moment because it's costing a lot of money to build new houses, and they're struggling to sell those new houses for a lot of money. So, like I say, it's more scientific than that, but that's the crux of it. Inflation has pushed the cost of building, whether it's the materials or the labor or the land or whatever else, has pushed those numbers high. They're continuing to grow. Inflation is not spiking like it did a few years back just yet, but it is positive, and it's outpacing house price growth in general. Perhaps not in every sub-district and region, but in the UK as a whole, and particularly in places like the southeast. So operating margins are being squeezed because the costs are going up and the revenues are not particularly moving up. That is a problem with no particularly easy solution. I don't think disinflation of labor costs or material costs is on anyone's bingo card for the near future. And I think house price growth is also is not something that anyone's getting super excited about. So like I say, a sticky wicket because those low margins are for the time being at least, looking like they could well persist. Now, government policy is like you say, kind of the X factor in all of this. It's the unknown quantity, but it also swings both ways, and we'll see what Andy Burnham says later today. But there's a few ways that this can go. Now, the good news is there's levers that can be pulled within government to support housing. Famously, things like the Help to Buy. The Help to Buy scheme have boosted fortunes of house builders. They've also boosted house prices, and hopefully, I think it's fair to say, also boosted the prospects for first-time buyers and so on. But not without a bit of controversy along the way. So that's quite a careful lever that someone would have to pull, and it'd probably be slightly reformatted before it was relaunched, if it were relaunched. On the flip side, doing something that enrages or frustrates the bond market and sends interest rates higher, of which there are many other policies that can be enacted that accidentally or intentionally do that, I suppose, that is going to have a meaningful negative impact on house prices and therefore the sector as well. As I'm sure you can imagine, if the cost of a mortgage goes up, the price that someone is willing or able to pay goes down or doesn't grow as fast. And that is an issue that could impact this sector negatively as well. So it's a tricky starting point. There are changes that could occur either intentionally or as a byproduct of something else that could be good or indeed could be bad. But it's right to identify that it's quite a volatile sector, and one where a few key changes could have a real outsized impact. For example, that if the Help to Buy scheme were to be resurrected today, and I'm not saying that it will, that's not actually on my bingo card, but something like that could happen. The whole sector would completely sort of change in terms of its outlook and the opportunity that exists there. So it's one to keep an eye on, even if it doesn't look particularly exciting right now.
Thanks, Oli. Well, look, I think we'll wrap things up there. Thank you, Richard and Oli, for your time and sharing your insights. I hope you enjoyed today's discussion. We love to hear from our listeners, so please review the show now or wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We will be back next week. In the meantime, head over to our website at www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, if you have any questions you'd like to ask one of our experts, simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you, Richard and Oli, for your time, and for all of you for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.